You ever notice how your bank balance and your profit and loss statement live in two different universes? Your accountant says you made 50 grand last month, but you're scrambling to cover payroll Friday. That's not just bad luck. That's traditional accounting lying to your face about how construction cash actually works. I'm Wade Carpenter, and today we're talking about why profit first for commercial construction works when everything else fails. Because here's the deal: construction cash has different rules than retail, restaurants, or any other business your CPA learned about in school. And if your money system doesn't honor those rules, you're going to stay broke no matter how many jobs you win. Traditional accounting was built to report what happened last month, not to help you run a project based business this week. It's like trying to frame a house with a butter knife. Technically, it's a tool, but you're going to hurt yourself trying. Here's what I see every single day: contractors with profitable jobs on paper can't make payroll without a line of credit. Work in progress reports that look healthy while the checking account's drier than week old cornbread. Retainage sitting on the books like it's real money when it's actually locked up tighter than Fort Knox. Your P&L says you earned 100 grand, but 30 of that is tied up in retainage you can't touch for 6 months. Another 20 is sitting in unbilled work because your change orders aren't processed yet. And 15 got spent on overhead before you even realized it belonged to the job. So what's actually yours? About 35 grand. But traditional accounting treats all 100 like it's sitting in your checking account ready to spend. That's the fundamental problem. Accrual methods mask the timing and restrictions built in every construction job. They can't tell you if you're underbilled relative to costs burned. They can't warn you that overhead's quietly siphoning cash that belongs to jobs. And they sure can't answer the most basic question a contractor needs answered: can I make payroll next Friday without borrowing? Let me show you exactly where the wheels come off. Problem number one: WIP illusions. Your accounts receivable shows $200,000, looks healthy as a horse, but buried in that number is 30 grand in retainage you can't access. And the WIP might be underbilled by 40,000 because your change orders are stuck in the owner's approval process. Quick math on the napkin here: 200 minus 30 is locked retainage, minus 40 in underbilling equals 130 in actual available cash. Not 200. You just lost 70 grand of breathing room because the books don't know the difference between earned and collectible. Profit First for commercial construction spots this gap weeks before your WIP report catches it through simple bucket stress. When your AR is fat, but your JobEx account is drained, that's a flashing red light that you're underbilled or collections are lagging way behind execution. Problem number two: retainage treated like real money. Traditional accounting rolls retainage into receivable like it's sitting in your checking account. That's about as useful as a screen door on a submarine. Here's what happened: you book $100,000 in revenue, 10 grand is retainage. Standard accounting says you earned the full 100. So overhead gets hungry and spends that 10 grand on insurance premiums and office rent. Then 9 months later, the job's ready to close, but retainage release gets delayed because of punch list disputes. Now you're borrowing money to finish a job you already made profit on. Profit First for commercial construction treats retainage as restricted, never available for overhead. You price jobs knowing you got to carry that 10% until final release, and you fund that carry cost through your POT allocation targets. Problem number three: deposits disappear into overhead. Customer cuts you a $50,000 deposit for a long lead steel that you need. Traditional accounting drops it into your operating account and tracks it on the balance sheet. What actually happens? That 50 grand gets sucked into overhead before you even order the steel. Then the steel shows up. The supplier wants to get paid, and you're scrambling because somebody spent other people's money on your problems. Profit First for commercial construction solves this with a dedicated job deposits liability account, escrow style holding that keeps that 50 grand locked for its intended purpose. That deposit money has exactly one job: buy what the customer paid for. Problem number four: job costs and overhead blur together. When you pay subs, materials, permits, and bonds out of the same account you use for office rent and insurance, overhead becomes a pickpocket in a three-piece suit. Your gross margin disappears into thin air because job money and business money are all mixed up like ingredients in a bad stew. You think you're running 25% gross margin, but overhead's been quietly eating into job cash. Your actual margins are 18%, and you don't find out until the WIP report hits your desk weeks later. Quick napkin math. Job brings in 100 grand. Direct cost should be 65. Subs, materials, permits, bonds. That leaves 35 for overhead and profit, right? But because everything flows through one account, overhead sneaks another 10 grand out of job money. Now your real margin is 25 instead of 35, and you just lost 10 points of margin without even knowing it. Profit First disciplines this with a dedicated JobEx account. Every direct job expense, subs, materials, direct field labor, permits, bonds, job specific rentals, flows through JobEx. Nothing else. Clean separation, visible gross margin, protected job cash. Problem number 5, payroll rhythm gets ignored. The original Profit First book says allocate money on the 10th and 25th of every month. That's fine if your payroll runs on an accountant's calendar, but construction payroll doesn't care about arbitrary dates. It cares about promises you made to your crew. Profit First for commercial construction adapts the rhythm to weekly or biweekly allocations synchronized with your actual payroll cycle. Cash discipline that strengthens payroll reliability instead of competing with it. Here's where everything changes. Profit First for commercial construction starts with a simple truth most contractors never hear. Real revenue in construction isn't revenue minus materials and subs. It's revenue minus everything that belongs to the job. The JobEx account becomes your best friend and your toughest teacher. Every direct job outflow routes through here. Subcontractor payments, materials and supplies, direct W-2 field labor when you charge it job by job, permits and bonds, job-specific rentals, and equipment. What's left after JobEx is what's actually yours to operate on. Not what the books say you earned, what you actually have available after honoring every job commitment. This makes gross margin behavior visible immediately. If JobEx is burning faster than revenue, you don't need a fancy WIP report to tell you something's wrong. Your bank balance will whisper the truth loud enough for the back row to hear. Profit First for commercial construction formalizes the whole system with one simple equation. Revenue minus JobEx minus OpEx equals POT, where POT equals profit, owner's compensation plus tax. That's it. That's the whole game right there. The formula shifts your entire team's thinking from how much revenue can we book to how much cash can we actually distribute after we handle jobs and overhead. When POT falls short, the problem's obvious. Jobs are underpriced, JobEx is leaking, and overhead's too fat. No mysteries, no excuses, no accounting mumbo jumbo. Let me give you a quick example. Say you bring in $100,000 in revenue this month. JobEx burns 65, subs, materials, permits, the whole 9 yards. OpEx 620, office, insurance, admin salaries, junk payments. That leaves 15 for POT. 15% POT might be your target. Great, you hit it. But if POT comes in at 8%, you immediately know something's broken. Either jobs aren't priced right, job costs are out of control, or overhead's eating your lunch. Now, here's the ninja move. Allocation calibrated estimating. You embed these target percentages right into your bid math. Every job you win already knows how to fund JobEx, OpEx, and POT. Jobs become self-funding instead of cash draining. Profit First for commercial construction doesn't just reorganize your money, it builds fences around it so every dollar knows its job. Here's your core setup. Income account. That's your holding tank where revenue lands. Not where you spend from, just where your money waits for allocation. Your JobEx account. All direct job costs flow here. Overhead can't touch it. Your gross margin becomes visible faster than a red truck on Sunday. Your OpEx account. Overhead only. Your rent, insurance, admin, marketing. You never pay JobEx from here. Profit account. That's your quarterly distributions aligned with project completions, not arbitrary calendar dates. Owner's compensation account. Your pay, separated from employee payroll, so you stop being the lowest paid person in your company. Tax account. That's funded for the POT we calculated earlier, so April 15th doesn't crater your cash flow. Now, here's where Profit First for commercial construction really earns its keep. Construction-specific accounts that honor the weird physics of project cash. Payroll account. Separate from OpEx to isolate payroll burn, reduce fraud risk, and forecast hiring capacity with precision. You'll know exactly how many people you can afford to hire before you make the offer. Job deposits liability. Escrow style holding for commercial prepayments. That deposit money stays locked until you buy what the customer paid for. No exceptions. Materials pre-buy. That's segregated funds for long lead or price volatile materials. Maybe that's steel that takes 12 weeks to deliver, lumber when prices are swinging wild. Keep it separate so it doesn't vanish into overhead. Drip accounts. Maybe a seasonality buffer. Pre-fund those known slowdowns. Winter doesn't have to mean borrowing season when you've been setting aside 5% all summer. Your CapEx account. Equipment purchases and major repairs funded through OpEx and JobEx. So when that excavator finally gives out the ghost, you're not creating job cash to replace it. For really big jobs or say a multi-million-dollar project, you can add project-specific sub-accounts to isolate cash flow and retainage per job. It keeps one job's mess from contaminating another job's money. Here's one of my favorite parts about Profit First for commercial construction. Your bank accounts become an early warning system. Traditional accounting tells you what happened last month. Profit First tells you what's happening right now. Signal number one, fat AR with an empty JobEx. What does that mean? You're underbilled relative to job cost burned or collections aren't pacing execution. So what do? Increase billing cadence, tighten pay app documentation with subs, push the owner to process change orders faster. Signal number two, strong billing, but OpEx is straining. What does that mean? Execution or pricing is probably off. Jobs aren't carrying their share of overhead. So what do? You review your job costing on current projects. You adjust your bid calibration on future work. These cash signals surface earned value versus billed value gaps weeks before the month-end WIP adjustments would catch them. Early visibility means early correction, and early correction means survival. All right, you're sold. Now what? Here's your implementation checklist. 5 moves that turn theory into cash in the bank. Move number 1, bank architecture. Set up your core buckets: income, JobEx, OpEx, profit, owner's comp, tax. Maybe add payroll right away. Then layer in construction-specific accounts, job deposit liabilities, maybe a materials pre-buy, a drip, a CapEx, as you need them. Start simple. You can always add complexity later, but get that JobEx separation locked in from day one. Move number 2, rhythm discipline. Adopt weekly or bi-weekly allocations synchronized to your payroll cycle. Don't fight your payroll schedule, work with it. Time your quarterly profit distributions to project completions and retainage releases. Don't pull profit from jobs that haven't closed clean yet. Move number 3, bid to fund the system. Use allocation calibrated estimating that bakes your target JobEx, OpEx, and POT percentages into every bid. Price explicitly for retainage. Carry either through elevated POT targets or schedule aware margins. Here's a quick example. If your target OpEx is 20% and POT is 15%, your bid needs to price at least 35% over JobEx. JobEx is 65% of revenue. You're bidding at minimum to hit break even. Build in buffers for retainage delays, and you're pricing at 70 to 75% for JobEx and OpEx combined, leaving 25 to 30% for POT plus margin cushion. Move number 4, protect project cash. Route every direct job expense through JobEx, no exceptions. Keep retainage restricted and never available for overhead spending. Segregate deposits and pre-buys in their dedicated accounts. This is non-negotiable. The moment you let overhead steal job money, the whole system collapses. Move number 5, train the team. Your field staff and subs need to understand why documentation and pay app cadence matter. Faster approvals mean shorter cash cycles. Tighter documentation means fewer disputes and faster retainage release. Look, traditional accounting tells you what happened. Profit First for commercial construction tells you what to do. When you implement this right, financial reporting becomes a daily operating system that honors construction's weird cash physics. Retainage delays, deposit timing, WIP cycles, and overhead creep. Jobs fund operations. Operations fund growth. And payroll, owner's compensation, and tax come from what's truly left, not what the books pretend is available. No more overhead stealing money. No more blind spots where cash crises hide. No more hoping accrual profits will magically turn into real cash. Profit First for commercial construction ensures your project-based business consistently funds what actually matters from real cash on real schedules in the real world of construction. If you're tired of being the bank for your customers, your subs, and your overhead, and you're ready to actually keep some of the money you earn, grab a copy of Profit First for commercial construction on Amazon. It's the full blueprint for everything we talked about today. I'm Wade Carpenter, and we'll see you on the next one.